This is Sacha Pradyuman of Cirrus Research. The latest outlook is just out. It's in the dispatch. One of the topics covered in that report is summarized here in the Cirrus Foundation series. The size premium and links to EM and international markets. This is a big deal. What we've observed over the last few years is that I think enough of us has noticed that as we've seen a rotation to international markets, EM, and even over the last year, smaller caps have started to bounce back. There are a few interesting similarities that we found in there. Number one, the valuations among large mega caps were excessive, not just by the US measures, so large versus small, but also US versus rest of planet. And this got us thinking a bit about how these gaps have opened and now they're starting to reverse and they seem to be moving in tandem. So we took a closer look at a set of data. And what we learned was that this sort of size premium is actually linked to as well international markets. In other words, the preference for mega cap stocks in the US sort of diminishes the preference for small stocks by definition, but also overseas markets, including emerging markets. And the data sort of backs us up. So this diagram, I think we try to represent what we're seeing here, which is effectively a seesaw. And on the one end are large mega cap stocks. And when you look at it, margins are at record highs, valuations are at record highs. And as a result, the seesaw has swung this way. Now, in the last year, we're starting to see a reversal. So what's curious is that emerging markets have done well, international markets have done well, and then in the last year, we started to see small caps work better. So the question is, what's the pivot point here? What's driving this? And a lot of that, I think we've reduced to is the geopolitical risks that have surfaced in the last 12, 18 months. At the end of the day, what we've got is a pickup in gold prices that really shot up, which is in a way representing geopolitical concerns. So we can use that as data to test this idea out. But besides rich valuations, what we're also seeing is record margins for US large stocks. They're always higher than smaller stocks. But the point of it is that if you have rifts that are starting to surface among trading partners, then let's say pristine margin assumptions you got are likely going to fade. And it's that break in margin assumptions that's, I think, allowing these rotations to occur. So not only is the large cap margins very high, but large tech really is off the scale as far as we have the data going back 30 plus years. And then within there, specifically for AI, the semis group, the margin there, it's effectively 50%. So 50 cents on the dollar is going back to earnings and cash flow. So this diagram we've worked up sorts of represents this idea that we've got, which is you've got a proxy of geopolitical risk. The question is, as that picks up, then and only then do valuations matter. So in other words, we can use gold as a proxy for geopolitical risk. It could be tariffs, it could be wars, inflation. But nonetheless, we now have a proxy. And then from there, if you've got this turmoil, valuations matter. So you can make comparisons large versus small or small versus large. And on the other hand, you can also look at margins. Are margins excessive or at risk? And as a result, if you follow the logic through, you can get to a point where small stocks, international, emerging markets begin to outperform mega caps and vice versa. And so the key insight here is that increasing geopolitical risk, it really forces investors and acts as a trigger for rotational markets. Empirically, let's look at the data. The blue curve represents gold, and here we have adjusted it for risk assets. So as this blue line climbs up, gold is really outperforming. And as it decays, by definition, is lagging. We overlaid the small cap, large cap performance cycle here, and they coincide. You've got the 70s where gold rose, small caps outperformed. You had the 80s into the 90s where gold collapsed and small caps really broke down. And vice versa, it did reverse again from 2000 up to about 2011. What you'll notice is that gold prices also rebounded, and so on. When we look at the data, what we're seeing is that during the 70s, you had really small caps outperform. We didn't have the emerging market data back then, but if you look into the 80s and 90s, what you had was larger caps outperformed, large growth did the best, small value did the worst. And then right in there was developed markets as well. In the 90s, you have a decade where gold prices rose. What you got was small caps outperforming, small value performed well. But now we have the emerging market, developed market data. The emerging market results did the best during that period, and so on. So the punchline here is that this idea of other risk assets like small caps, international emerging markets, I think they are tied at the hip. And it's this pivot point that as you start to get geopolitical rifts, it forces valuations to matter. And that's what drives these rotations. Take a look at the full report. And as always, happy to take your questions. Thank you.